Hi everyone, welcome to this random video that I just decided to do. It is financial reporting, and today we're covering IFRS 13. As usual, there's no introduction music, and this is tutorials with Tubby. So, a lot of the time, we get a lot of calculation questions and discussion questions when they ask us for IFRS 13 concepts. And we don't understand what the standard even is for. So when you're asked a question like this, you often don't know how to approach it, or you miss the signs completely. So it happens, and I'm going to try and alleviate that concern of yours. One of the fundamental principles of the whole fair value measurement concept is that it is an exit price. That means we need to understand what someone would pay from the objective standpoint to sell a specific asset or have someone take over their liability / transfer a liability. So I'm going to get into the formal definition now. The formal definition as per IFRS 13.9 of fair value, it basically defines fair value as the price that one would receive to sell an asset or pay to transfer a liability. Remember, transferring a liability means someone's taking over your liability in an orderly transaction between market participants at the measurement rate. So that would mean a lot of everything if I weren't to break these concepts down in the next slide. So orderly transaction is something we need to break down, and market participants. The measurement date I will break down specifically for financial and non-financial assets, and we will do this fair value thing together. What's an orderly transaction? What's this exit price I just spoke of? When is the measurement date? So let's get into it. An orderly transaction is exactly that. It's happening in an orderly fashion, in an ordered and planned manner. So it's a transaction that's not forced. It's a transaction that's not judged. So if there's a judgment from a court that says this person has, that is not an IFRS 13 fair value. It has to be a planned decision. It's what an independent user who is not rushed would consider through doing thorough research in terms of normal market activities. So this also means that it's the price someone would have to pay, and this is an exit price. So it's the price someone pays when they transact on their knowledge, research, and someone who's actually able to transact. So an exit price is the price you would pay to transfer liability to someone else or to sell an asset to someone else. So that person has to be rational, they have to be knowledgeable, and they also have to be able to transact. So it shouldn't be forced is what I'm trying to get at. So in a theory question, if they ask you for this, this is where you start from. The measurement date is obviously the date that's applicable, right? When we measure that asset. So the date that's applicable would depend on the standard. So IFRS 13 reverts you back into the original standard that you use to determine fair value. So this would be IAS 16 PPE for the revaluation model, or IAS 40 investment property for the fair value of that. But I still haven't answered the question, what's the standard for? So in an ideal world, we basically recognize fair value using things we can see. So listed shares are a really good example. You see listed shares for one company, and you say that based on this one company, the second company, which is in the same industry, would be worth something similar. You have market participants. You have rational, knowledgeable, and people who are able to transacting in that type of market. Or even property, price, and equipment that's purchased from a store. So if you purchase a financial or non-financial asset from an active market, it's very easy for us to be able to determine the price. But what happens when you don't know where the value of the product comes from? When the product is a specific piece of land that's located in a very unique and very niche area that serves a very targeted market, what do we do then? How do we measure the fair value without this guidance? And this is where IFRS 13 comes in. It helps us categorize information when the asset selling or the liability transfer information is murky. So it gives us techniques to use and what to disclose in the determination of fair value. So now fair value is categorized into level 1, level 2, and level 3 instruments. It's the guide for fair value of everything. So I want to go back. Level 1 inputs, totally observable, your listed shares. Level 2 inputs would be something like this land I just spoke of. This land I spoke of would be, it has some unobservable inputs, but most of them are observable. And then obviously level 3 would have significant unobservable inputs. That means that a lot of guesstimation has to happen, obviously using valuation techniques in order for this fair value to be determined. So it's important to note that under IFRS 13, we mostly speak about market participants. And as I said, they are both willing, so they're not forced or judged, and able to trade. IFRS 13 Appendix A, please read your definitions. Read the definition of highest and best use for a non-financial asset. And IFRS 13 Appendix A defines that market, the principal market, as one with the greatest volume and activity, because we are trying to maximize our assets' fair value. It is where most people are willing and able to trade. There are effectively two types of assets we're dealing with here, and I've mentioned financial assets and non-financial assets. So a non-financial asset, for example, would be property, plant, and equipment. However, regardless of that type of asset, IFRS 13 states that the fair value must consider the condition of the asset, the location of the asset, and any restrictions on the sale of that specific asset. Principal markets versus advantageous markets. So principal markets are those where an entity will just normally trade, and that's where, as I said in the slide before, there are the most participants that are willing and able to trade. However, if you can trade elsewhere, there's sometimes a most advantageous market. Unfortunately, IFRS 13.15 says that, IFRS 13.16b states that it is only when there's an absence of a principal market, so where you would usually trade, that you can use the most advantageous market. So an advantageous market is when you realize that you can actually make more money here. This isn't your usual market. It's not where the most people are willing and able to trade. But if there is no principal market, you can then go to the most advantageous market. You can't decide that because the fair value of my asset is higher in a different market, that I'm now going to go suddenly trade in that market. That's not the fair value. It's where a willing and able buyer is to trade in a principal market. And the market participants are assumed to be market participants in that principal market. So as I said, IFRS 13.16 A and B says that it's only when there's an absence of the principal market that you can use the most advantageous market. And this transaction always happens under current market conditions. Huge debacle with COVID that happened in terms of fair value measurements. So that is not something I'm going to get into, so I'm going to move on to the next slide. IFRS 13.11 leads us to speak about assets and liabilities. So I just want to go back to IAS 1, which is one of the most ignored standards, but also one of the most important standards we can think of. IAS 1 states, it starts the principle by stating that we can't aggregate items that do not share similar characteristics. So IAS 1.29 speaks about materiality and aggregation. So if land, buildings, and inventory were all clumped into one item, that would not be fine because they're not of similar characteristics. You can't aggregate them because they're not the same. So this continues into IFRS 13 Appendix A, where you group assets according to their similar natures. And that is what is called a unit of account. So a unit of account becomes really important because if you're buying or selling a business and there's a group of assets that are similar in nature, you can actually determine the fair value of a unit of account. Then you can get two types of assets. Financial assets, which are normally equity instruments like shares, or you can get non-financial assets, and as I said before, it's PPE. Your land, your buildings, and your equipment is a non-financial asset. So for non-financial assets, how do we measure the fair value? Two things to think about when we speak about the land, equipment, and buildings. First one is, can the market participant use this asset, or can they sell it to someone who could use it? So per IFRS 13.27, selling an asset to someone who could use it or selling it to a market participant who could actually sell it is referred to as the highest and best use for that non-financial asset. And as I said here, it's supported by IFRS 13.B2B. So make sure to read up on these sections, pause the video, go highlight, because you now understand the basics of IFRS 13, and it's going to be fantastic for you if you get that IFRS 13 question coming up. So when assessing the highest and best use of a non-financial asset, there are three key areas that must be considered, and this is under IFRS 13.28. We're not on IAS right now. So is it physically possible to use this asset? So if it's in the mountains where no one can have access to it, it's not physically possible. What is the highest and best use? Is it physically possible to use the asset? Is it legally permissible? So sometimes there are restrictions that are applicable to property. So you are zoned into Section A and you can only use it for XYZ purposes. And also, is the usage financially feasible? So this helps us determine the highest and best use. Financial feasibility is about, will it generate some form of investment return for that market participant after the costs they need to incur to convert that asset have effectively been incurred by them. So subtracting those kind of costs, is it actually going to be an investment return? Is it financially feasible to purchase that asset? So this is what we're referring to when we speak about highest and best use. So the highest and best use assumption, in your discussion, your highest and best use assumption is for non-financial assets, and it doesn't change if entity X is holding the non-financial asset for a patent and entity Y is holding that financial asset. I'm thinking of IFRS 9. So the non-financial asset, if the company is holding a non-financial asset, company XYZ is holding that non-financial asset to pretty much trade in a specific sector, which is a patent, and that asset is bought by company ABC, and ABC is now holding this for preventing their competitors from buying the same product. Do you see that the use of this is different? It's a completely different use. One is trading and the other one is holding it to prevent someone else from creating the same product. It doesn't change if the entity holding the non-financial asset uses it differently from that market participants. It's a market-based measure, and once again, we care simply about if they're willing and able buyers. So regardless, fair value is always measured using directly observable prices or by using another valuation technique. The fair value of a liability or equity, both financial and non-financial, because we've spoken at length about the asset part. IFRS 13.34 again allows us to make a certain assumption and says that measurement date is the date where the entity measuring the liability or equity, even though it's not transferred at this date, but it's the date when we either will fulfill the obligation for a liability or the date on which the equity instruments rights and obligations will be transferred to that market participant. This is for a liability where they'll fulfill the obligation, and an equity instrument where the rights and obligations will be transferred to the market participant. So if you're ever asked for the fair values, I would refer back to these, the non-financial assets fair values being their highest and best use, the financial and non-financial values, the fair values of liability and equity, I would refer back to this. Let's speak about liability fair values in detail. When measuring the fair value of an entity's liability, we use a quoted price. That is best case scenario. It's the same for an asset. We are going to use the best case scenario, which is what we can see, what's directly observable. It's a quoted price. We know that this liability is 500,000 Rand, so that's the price we've seen. But what happens when the quoted price is not available? We use an identical item that is held by another party as an asset, so we'd measure that. Either the liability, the equity, or the asset using the information of someone who holds something similar to us. But if the liability doesn't have a quoted price and it isn't held by a market participant, the fair value must be determined on a specific valuation technique that reflects the perspective of a market participant, in this case, agreeing to take over or assume that liability. Getting into valuation techniques. As I said, if the valuation technique, if the fair value of an asset or liability can't be directly observed, or it can't even have similar observable inputs, then IFRS 13.61 and IFRS 13.62 says that a valuation technique must be used. So in using your valuation technique, you have to have sufficient relevant data that allows us to measure fair value. You need to maximize the use of relevant observable inputs. So, for example, if you have a share and it's trading in the manufacturing industry, you're going to take another manufacturing industry's shares and work back on that. So that's the observable input. What if there's a discount rate to be factored into your input, into your shares? Then you have to minimize that use of unobservable inputs. And that's because estimations are less reliable. And finally, the three main approaches as per IFRS Appendix B5 to B11 that enable us to measure fair value. The first one is the market approach. It uses prices and other relevant information to sort of value that identical or comparable asset or liability, or units of account, which are groups of assets and groups of liabilities. This would be something such as a business. So it uses prices that are generated by market transactions. Then the cost approach. The cost approach reflects that amount that someone would incur to replace that asset. It's called the current replacement cost method. So if you purchased a similar asset that would offer the same service capacity, how much would that cost us? And that current replacement method is often used to measure the value of tangible assets, such as factory plants and other assets and liabilities that are tangible assets. Then the income approach, which is the most common approach that you will get in any test or exam, is the income approach. It converts any future amount, such as a cash flow or income and expenses, into a single current discounted amount. So this is the present value technique, which I will be covering the actual mechanics of in slides preceding this when I do the ITC September 2021 exam. So I spoke about the fair value hierarchy, kind of touched on it earlier. The inputs that you use to measure fair value reflect only those characteristics that a knowledgeable market participant who's done thorough research would be expected to use. So assess which of these inputs are available, and then in order to improve that reliability, remember we use level 1 inputs as our best estimate. It's first prize. And level 3 inputs are literally your bronze, your third prize. So we need to start ranking these inputs using a fair value hierarchy, and when performing the valuation, let's say there's a level 3 instrument, we have never seen something like this before, you need to maximize the use of level 1 inputs, so the observable inputs, and you need to minimize the use of level 3 inputs, so something like a discount rate, for example. As I said, unobservable inputs are less reliable. What are you corroborating them to? Therefore, if there's a level 1 input, the entity has no option but to use that level 1 input in the valuation technique. IFRS 13 is very clear about this. You cannot use level 3 inputs when there's a better, more observable input that can be used within that valuation technique. As I said, an example of a level 1 input is a share listed on the JSE, which is an active market. And we would use this to measure an investment in shares, for example. Level 1 input, quoted price, it's not adjusted because there's an actual active price in an active market. Second price, silver, are level 2 instruments. These use other inputs to level 1 as per IFRS 13.81. So what are these other inputs? So these would be other inputs for other identical or similar assets or liabilities in other active markets. So you'd use the interest rate of another comparable entity. You'd use the interest rate to calculate the shares of another entity. If you do not have the fundamental data to calculate your own. So an often used example I've seen practically of level 2 investments are land. Land is not 100% level 1 because land differs. But if I have a property and person X has a property in the same neighborhood that has the same soil texture, and that land in both properties is comparable in terms of its usage purposes, in terms of its size, in terms of its everything, then the independent valuator would come in and sort of tweak the assumptions that we can see from another piece of land, and that is how you determine the fair value of a level 2 instrument or a level 2 investment. So level 2, think about it like this: some observable inputs and some unobservable inputs. Level 3 is where the game changes. Level 3 inputs are the least reliable because they're unobservable. But you have to measure fair value to the extent that the relevant observable inputs are unavailable. So level 3 inputs, where there's little to no market activity, are the ones where we allow fair value determination for those. Remember, I told you at the beginning, the objective is still the same. We're trying to estimate a price from the perspective of a willing and able market participant that will either hold the asset or will owe the liability. So they're taking over the liability, or we're selling an asset to that market participant. So let's speak about the present value technique, because I was talking about it this entire time. So to go back, the income approach speaks about the present value technique. And speaking about the present value technique, it effectively discounts the cash flows. So all the future cash flows are discounted using a discount rate. You would have known about this from financial management, where you're calculating the discounted cash flows of a specific item. So one, you have to estimate those future cash flows. So you'd probably be given projections in terms of the increase, in terms of the growth rate, the inflation rate, or some form of increase matrix that they use. You also have to consider the time value of money, and that's where the discounting comes in. Sometimes you have to include a risk premium if your company is riskier than the company's rate you are using, so you'd have to discount it at a risk premium. You would know this from the CAP-M in financial management, whereby you would add that risk premium to your risk-free rate, and then any other factors that market participants would consider is something you'd include. So in the example that I'm about to provide, September 2021 ITC, link will be in the description box. You have to include any other factors that any market participant would consider. So if there's strikes, if there are riots, if there is a declining demand for that area, if it's really not a good area to invest in, these are the kinds of things that have to factor in to your determination of the present value. Let's talk about disclosure. So IFRS 13.91, and this is the one I highlighted because level 3 is actually the very complex one. For recurring fair value measurements using significant unobservable inputs, i.e. defined as level 3, the effect of the measurements on the profit or loss or other comprehensive income for the period. So you need to assess that. You need to assess the effect of these measurements on profit or loss or other comprehensive income. This one, I highlighted just the relevant parts of it, and I think this is IFRS 13.93. It says that for level 3 investments, the amount of total gains or losses that's attributable must be included from the change in unrealized gains or losses. Also, If you have a level 3 investment, you need to describe what valuation processes were used by the entity. And then finally, you have to provide a narrative description of the sensitivity of the fair value measurements to changes in these unobservable inputs. So if you're using a discount rate and that discount rate is susceptible to change, you have to speak about why is it susceptible to change and what is that unobservable input that is actually susceptible to change. ITC September 2021, we have this company called, sorry, I'm going blank. We have this company called Europrop and Eurotile. So first and foremost, we were given a whole lot of background, but I only kind of highlighted what I needed to highlight in terms of this question. So there's social unrest. Obviously, that would affect our fair value because it affects the safety of the wholesale customers who collect tiles and tile adhesive directly from the warehouses. So a willing, knowledgeable, and able market participant would factor this in when determining the fair value of that particular property. There have been reductions in consumer spending in the past few years, which has negatively affected Eurotile's group revenue. Many competitors have reduced profit margins in order to survive. And then here, the expected South African inflation rate for the foreseeable future is 4% per annum, while the South African economy is expected to grow by a mere 1% per annum. So that's the inflation rate we care about. This is properly here to confuse you, but the inflation rate will be whatever we increase our projections by each and every year. So that's inflation, and that's the social unrest. Eurotile leases its factory building in Vereniging from Europrop. The lease agreement will continue until 30 June 2026. This was a 30 June 2021 paper, so it's 5 years, at which the factory building and the land will be disposed of by Europrop at its estimated value of 5.75 million, including VAT. So here, we need to strip out the VAT, and there'll be a future inflow of cash due to the proceeds of disposing of the factory building and the land. 5-year lease. Then here we're told that Eurotile paid annual rental in arrears of 2.76 million, including VAT, on 30 June 2021, where the lease commenced. So what would this be? This would be a future cash inflow because we are Europrop. Remember, we are Europrop. I should have added the organogram of the group here, but we are Europrop and Eurotile is leasing from us. So Eurotile paid annual rentals in arrears of 2.76 million, strip out the VAT. The rent is subject to an annual inflation-based escalation clause. So now we know escalation is going to be at 4% per annum. This, as I said, basically there just to confuse you. So that is the cash inflow. Europrop incurred an annual operating expenditure of 1.104 million to properly operate and maintain the factory building. We incurred the expenditure as Europrop, so annual cash outflow, which is also VAT inclusive. So we have to exclude the VAT from this. Both Europrop and Eurotile are category C VAT vendors. Building acquired 5 million, that's not relevant for fair value. But what is relevant for fair value is that it is the accounting policy of the Eurotile group to subsequently measure all investment properties using the fair value model in terms of IAS 40. The fair value of the factory building and land, 6.059393 million on the 30th of June 2020. And how did they calculate the fair value? They deducted the accrued lease income of 1140607. I'm going to give you a quick exam tip. So when you are having reading time, what I would do during reading time is that I would first start by reading the question, obviously, and then highlighting similar things in the same color. As you can see, I highlighted the fair value of the factory building was that. The fair value of the land and buildings is proportionally allocated in terms of the original cost price. None of these three things are the same color. So my eye knows when I see this particular color that I'm speaking about this thing. So in a perfect situation, I would have highlighted all the dates one color, the standards another color, and the amounts another color. So that when you are having your actual time to focus on the question, you're not totally lost and actually rereading the question when you get your booklet, your answer booklet. So this is prior fair value, and it's determined after the accrued lease income. We were told this. The group reviews its fair value estimate on a quarterly basis for significant changes. The process would also include a review of the discount rate. We are told about a discount rate that includes significant unobservable inputs. Now let's go back. These significant unobservable inputs already put it at level 3. So now we know that we're dealing with a level 3 investment. So what do we do with that level 3 investment? We need to note that the discount rate is really important because the discount rate is the level 3 unobservable input in this situation. So you'd have to apply the disclosure requirements for the discount rate. The group obtains evidence from third parties to support the reasonability of the fair value estimate. So that's literally a qualitative consideration of the fair value that management uses. So they gave us the amounts of how much income did we receive and how much expenditure did we incur. All of which was VAT inclusive, so we need to kind of get a hang of that. So Part F says prepare the additional journal entries to account for the IP and the lease in the separate records. So I'm not doing the journals, I'm doing the calculation with you. Assume that the appropriate pre-tax discount rate is 15%. So the second one is disclose all relevant information relating to, guess what? The fair value of investment property. So now you're disclosing this fair value information that you've just come up with. Where available information is insufficient, provide examples as to what you would include to complete the required disclosure. So I'm just going to bring this over here and I'm going to leave it to full screen, and I want us to talk through this. So if you will remember properly, our income that we've already highlighted was 2.76 million, or if you wanted to, you could use the 2,760,000. So that's exactly what I did. I said 2,760,000, stripped it out for VAT, and I included the inflation rate to it. And here, I just increased it by the inflation rate every year. Remember, the lease was from 2021 until 2026, but we already have the fair value for 2020. So we are trying to calculate it as at 30 June 2021. So that's for the 5 years. So then the operating costs, as I said, we already had them. These operating costs were determined by this journal, 960,000 Rand, and times 1.04. If you wanted to waste time, you could have said 1.104 times 100 over 115 to strip it off the VAT, and then multiply it by 1.04 each year. But I wanted to save time, and that's what I did, and I multiplied it for each year. So then I got the net lease income, or your net investment in lease, and that was all positive cash inflows. But do you remember that up here in the question, they said that they will be selling this for 5.75 million, including VAT, at the end of 30 June 2026. So this future inflow should flow through into my discounted cash flow calculation. So we're doing part F right now if you're a bit confused. Proceeds of 5 million rand, I got that by saying 5.75 million multiplied by 100 over 115. Then I discounted that using a discount rate that was given of 0.15, and I present valued my total cash inflows. I got an answer of 7865,106, and they told us here that they determined the present value after deducting the accrued lease income of 1140. So we know that accrued lease income needs to be deducted. So we had this accrued lease income at the end of this year. So it's the 63,089. And we also had accrued lease income of that's the operating expenditure. That's the 1104,123. So we had accrued lease income, and I just want to check myself, 1140,607, and that we would have gotten, 1140,607. So we now have to deduct that in order to determine our fair value for the year of 2021. And then for 18, I think, beautiful marks, you just end up calculating that. So that entire question actually had, that entire question was actually for 15 marks, excluding the journals, which were, I just want to check myself before I wreck myself. The journals were, the journals were for 2 marks, and of which 17.5 was attributable to the fair value calculation. So now for the second part, where they ask us to, I just went to the beginning. For the second part, where they ask us to actually calculate or disclose rather, I just want to go to that direct question. For part G, where they ask us to disclose any relevant information, what I would have is exactly what I've just shown all of you, and this is what I would have. So remember, we spoke about how they need to say significant unobservable inputs, and what you need to do is show the reconciliation of all amounts that affected our profit and loss. So I'm going to go back to just the disclosure requirements, and it says the amount of total gains or losses for the period included need to be disclosed for a level 3 instrument. So this is the fair value recon. We started off with 6059, which was given to us in the question. We ended off with the 6661411, which we just calculated using the Excel doc. And that means that the difference is the total gain for the period. I would have just said total gains for the period, which is 602,018. Therefore, your change in unrealized gains for the period included in profit or loss is 602,018. Then, next, you have to show the qualitative considerations of how your valuation technique is determined and how do you use it. And you also have to show the effect of the measurements in profit or loss. So let's see. The narrative description of the sensitivity to changes would have been determined further down in the question, but I just want to show you the quantitative information part. So you would have had your fair value at year end. How did you calculate it? You used the discounted cash flow method. What was our unobservable input? We were told in the question it's the discount rate. And what was the discount rate? They gave it to us at 15%. Going back now. Now you need to provide a narrative description of the sensitivity of the fair value measurement to changes in unobservable inputs. So remember I spoke about the protest. So obviously the unobservable input into the measurement of fair value is highly susceptible to qualitative factors such as violent protests in the area. That's 1 mark. Just by stating where the fair value is located, that's another mark. The entity's valuation policies are determined by the valuations committee. I would not have gotten that mark, but I would have gotten the mark of saying that the entity obtains evidence from third parties on a semi-annual basis to support the reasonability of the fair value estimate, which is 1 mark. And then you need to speak about the susceptibility, right? Significant increases in the discount rate would significantly lower or higher fair value measurement of investment property. The entity monitors the discount rate, which is the unobservable input, by recalculating it on a quarterly basis based on most recent information. Remember I spoke about the fact that there are strikes, and that comes through in this question. Then you would have said something along the lines of, okay, fine, this particular building, but simply by stating what the fair value measurement is, what the quantitative measurement bases are, and what the qualitative measurement bases are, you would have had yourself covered. And that is how we got 23 out of 48 on this paper. I thank you all so much for listening to this channel, and please subscribe. Cheers, bye. I thank you all so much for listening to this channel, and please subscribe.